Hey guys, Jordan from Precondo here. Today we are going to talk about the fact that the Greater Toronto area just saw rents crack $3,000, a new all-time high for rental rates. I'm going to go through what I find to be a more interesting story in rents. It's not just that Toronto rents are high, but what's really interesting to me is that the outskirts areas, Hamilton's, Barrie's, Kitchener's, are even higher relative to where they were pre-COVID. So let's go through some of the numbers here. So here we have this article from the Toronto Star. GTA rents hit record $3,000, creating a very alarming situation. We are all very alarmed, except for some of us, which are on the other side of the trade, and our rental rates are going up. So average rents in purpose-built apartments broke the $3,000 barrier for the first quarter of this year, the sixth straight quarter in which Toronto area rents have seen double-digit year-over-year increases according to Urban Toronto. So I want to go through some of the numbers here. In particular, this chart from Urban Nation, which shows purpose-built rents across the GTA. Now, of course, this is purpose-built, but condo rents will roughly trade in line with this. So you can see that average rent is now over $3,000 in the Greater Toronto area. Now, if we look at condo rentals specifically, you can go to condos.ca and they'll show you what rents are trading at actively on a per square foot value, and you can see that we are also at an all-time high there for Toronto specifically at $4.33 per square foot. Put another way, it means that your 600 square foot one in Den will rent for about $2,600 on average, and this rolls in both old and new buildings. So obviously new buildings or nicer buildings will be more expensive than that depending on location, all those different factors. You can see 600 square foot one in Den's pushing $3,000 a month in certain buildings, and of course it's up 13.35% year over year. This chart here from Urban Nation just shows you the vacancy rate in the GTA for purpose-built rentals for the first quarter of the last few years here. You can see that first quarter of 2021, mid-COVID, we were seeing a vacancy rate of 6.4%. Widely accepted that a healthy vacancy rate is somewhere around 3%. We're, of course, below that at 1.8% vacancy, which is trending close to where we were pre-COVID. Now, a lot of people seem to be shocked by the fact that the average rent in the GTA is $3,000. I, for one, am not shocked. I'm incredibly unshocked given the population growth we have seen in the past year. I mean, you take 1 million people, you add them to the country, 42% of them, right? So if you look at this chart here, 42% of them on average go to Ontario, which has probably the most stressed housing market in Canada in terms of supply and demand, right? When you see our population growth shattering 50-year records at the same time as purpose-built rental is at some of the lowest levels it's been in a long time, it's a pretty foregone conclusion that rents are, of course, going to push up as a result. But there is a story I find a little bit more interesting, and that is the story of the rental gap between secondary markets and Toronto. So I want to go through the May 2020 versus the May 2023 numbers for what a one-bedroom condo will on average cost you to rent. So if you look at Toronto specifically, in May of 2020, you could rent a one-bedroom for $2,125 on average. Of course, this was right at the start of COVID, so in January, the number was actually higher. It was about $2,300. And in May of 2023, this year, that same one bedroom will run you $2,526 a month, representing an 18% growth over the past 3 years. Now, if we look at Hamilton instead, you'll see that in May of 2020, a one bedroom averaged $1,485, and then fast forward to this year, $1,875. So that's up 26% in the last 3 years. So of course, through COVID, people left the city. They were looking for more space for less money. And it turns out that those inflated rental rates are quite sticky when you add 1 million new people to a country. Who would have thought? And then finally, we have Kitchener. So in May of 2020, $1,382 a month for a one bedroom. This May, you're looking at $1,912 for the same one bedroom, representing a 38% rental growth in 3 years. Shocking, yes. Unsustainable, maybe. But it does invite, from an investor standpoint, it does invite a little bit of opportunity when you look at these areas that are doing a lot better than Toronto in rents and are simultaneously much cheaper markets to enter, especially on the pre-construction side of things. So just to illustrate and drive this point home a little bit further, I decided to chart the one-bed average condo and purpose-built rental numbers from January of 2020 through May of 2023. And what you can see is the gap has shrunk, right? So if you look at the percentage gap in a Toronto rent versus a Hamilton or Kitchener rent for a one bedroom back in 2020, it was a much wider spread than it is today, right? And so as a result, a lot of investors are looking to these secondary markets because they are far less cash flow negative than an area like Toronto, especially with increased development levies, increased land costs, and increased construction costs that are driving up the pre-construction price in Toronto. Now, I wanted to show you some real life examples. So first we're going to go to the belly of the beast, the center of the universe, depending on who you're talking to, downtown Toronto. So this is 50 Power Street. This is a brand new building right on the east side of downtown. Great building. You got a one bedroom here that just rented for just under $2,300 a month. Here at 158 Front Street, again, just the east side of downtown, so very centrally located new building. You're looking at $2,350 a month on this one bedroom. And then we have 111 Bathurst, a little bit more central. Well, I guess central really depends on who you are. I'll probably get a little bit of flack in the comments for that one, but more central to me. This one's $2,300 a month. Now, if we head over to Hamilton, you're going to see that the rents are almost the same. As someone who grew up in Hamilton, look, I get it. You know, Hamilton's seeing a lot of good things. It's a lot better now than it was when I was a child, but look, it's still Hamilton. So here's one. This one has a terrace. So we're going to rule this one out. Let's move on to the next one. We have this one in Hamilton. This one's tiny. I mean, look at the size of that kitchen. It's like a kitchen for ants. This one rented for $2,000 a month. Here you have another one, $2,100 a month. Again, these are just one bedroom units. Here's another one in Kitchener. This one, $2,000 a month in Kitchener. We've got another $2,000 a month. And these are brand new buildings just occupied, meaning that there's a whole stack of similar units that are they're competing. They're all on the rental market at the exact same time, and yet they're still fetching $2,000 a month. And here's another one in Kitchener. $2,030 a month, just a one bedroom. So it seems to me, and by the way, this story seems to apply pretty much as far as you can go, right? While still having some relative proximity to Toronto. So how exactly does this tie into pre-construction? Well, look, new condo sales fell 74% in the first quarter of 2023. Now, this doesn't tell the whole story because we are obviously in the second quarter, and in the last month and a half, things have shifted rather quickly and rather dramatically. But if you look at units sold for the first quarter of 2023, you'll see that we did about 2,400, right? A normal year is 4,000 to 5,000, somewhere in this band here. And of course, last year was one of the hottest pre-construction years in over a decade, just over 9,000 unit sales. So of course, your year-over-year number, 74%, is going to look horrifying. But in reality, we did 2,400. We did about half what we usually do. And when you look at the unsold price per square foot, I think it tells the whole story. So the unsold price per square foot for a pre-construction condo in the GTA is hovering around $1,400 a square foot. Construction costs are up, development levies are up, land costs haven't really adjusted yet. And so as a result, the cost to build these things has not come down at all, right? So despite the fact that the resale condo market or the resale detached market might be down 10, 15% in certain markets, developers don't have the pricing elasticity to be able to reflect that in their prices. So you're just not seeing it, right? But what's really interesting to me is that 905 product, Hamilton launches, Markham launches, Aldershot, Oakville launches are doing incredibly well. We just saw Union City launch in Markham a few weeks back, and it's sold out it says 6 days. Again, I think it could have happened in 6 hours. There was thousands of worksheets. One bedrooms were oversubscribed 8-1, meaning for every one bedroom that was available for sale, there were 8 buyers who had gone to the bank and gotten bank drafts ready in case they got the unit they wanted. And then, of course, right after Union City, you had Carding House in Oakville from Mattamy, which was a great offering. All right, it was $1,100 a square foot, parking included in Uptown Oakville, that's what we call it. It's basically the preserve area. And rents in that area for a one bedroom at Oak & Co, Dundas and Trafalgar, you're seeing, $2,300 a month. So a little bit higher than Hamilton rents, a little bit lower than Toronto rents. But what's really interesting to me about that and the opportunity it creates for investors is, look, if you want to buy a pre-construction condo similar to this unit here on the east side of downtown, you are going to pay $1,700 a square foot, right? So you're going to pay $750 or so, $800 for a comparable unit, right? If you want to buy a similar unit to this in Hamilton or Kitchener, you're going to pay $500, $525, $550 maybe, right? So you're getting a $200,000 discount, we'll call it. It's not really a discount, but you know what I mean. You're getting a $200,000 difference in price, but your rent is only $200 a month less. So $200,000 on your mortgage, you're looking at well over $1,000 a month difference in carry at current interest right? But at the same time, your rent is only $200 lower. So your carry is much, much easier. So instead of bleeding a ton of cash, you're going to be far closer to neutral. And that is why, in my opinion, so many investors are looking to the 905s rather than the 416. And you might think to yourself, Jordan, over time, don't you think that maybe this rental premium, Toronto versus the outskirts areas, is going to correct? And I would say that that's likely. You're probably correct in that assumption over a longer term horizon. But at our current immigration levels, Kitchener or Hamilton rents certainly aren't coming down to accommodate that difference. The only thing you may see to correct this delta is Toronto rents increase at some point in the future faster than the other two markets. But that still means that you probably did better, at least from a cash flow perspective, right? Who knows with appreciation, because I don't have a crystal ball. We're all just throwing numbers at the wall and assuming appreciation based on historical gains, right? So it's just voodoo projections. But when you look at the actual cash flow situation, certainly you're going to be a lot better on those condos in Kitchener or Hamilton. I have two right now that I like, one in Hamilton, one in Kitchener. If you want details on that, link is in the description. But more importantly, guys, just like and subscribe. Thank you for joining me, and I'll see you guys next video.